The following is for entertainment purposes only. We are not financial advisors. We are not responsible for any losses, only the profits.
Wouldn't it be cool to catch the knife before it starts falling? That's what we're going to try to do here. Leading the way right out the gate, they're out of here. Who's them? The Federal Reserve to begin winding down portfolio of secondary market corporate credit facility. Federal Reserve Board on Wednesday announces plans to begin winding down the portfolio secondary market corporate credit facility, a temporary emergency lending facility that closed on December 31st of 2020. The SMCCF proved vital in restoring market functioning last year. I don't really believe that. Supporting the availability of credit for large employers and bolstering employment through the COVID thing that happened. Right? We'll aim to minimize the potential for any adverse impact on the market functioning by taking into account daily liquidity and trading conditions for exchange-traded funds and corporate bonds. Federal Reserve Bank of New York, which manages and operates the SMCCF, will announce additional details soon and before the sales even begin. This should be pretty crazy. SMC was established and approved by the Treasury Secretary and equity provided by the Treasury Department under the CARES Act thing that came out. It's like, we're going to coddle you. We're going to do everything that we do every single time something bad happens, and we're going to give some billions to the big corporate companies to bail them out, to stimulate the economy, right? It's the first time in history that I know where people were actually getting checks, so that was cool. So that actually happened. But did you know there was only $26 billion worth of corporate bonds? Isn't that weird? Is all they did to stimulate with the money printing they did? That kind of blew my mind. I didn't realize it was that small. Regardless, basically unwinding them, they're going to try to get rid of them. I don't know if they're going to be able to, because you got to have other people. It's still an exchange. They can't just like throw them off the roof and they're done. They got someone's got to pick them up. If no one's going to pick them up, stuff's going to start changing. All right, possibly valuations, devaluations of things, possibly currencies, possibly even interest rates. Where did all the rest of the money goes? You know, there was trillions printed to, you know, mom and pops down the street, I guess. You know, people that needed it. I guess people got those $1,200 checks. Again, I think that was kind of cool, but we're getting some unwinding from these corporate bonds. Pay attention. Remember, the banks made money by dealing with those corporate bonds from the government too. So the banks make the money the whole way through. No matter what happens, the banks are set up to make money on the downturns and the uptrends, because they're the ones loaning up and for and against stuff. If no one's going to buy them bags, though, just another excuse for banks to tighten lending standards. But they already have been, even with the stimulizers. So remember, banks got bailed out. The Fed was supposedly hoping that they would loosen lending standards to actually stimulate the economy, right? So some other people could get houses instead of having to rent or whatnot. It never happened because the banks were like, no, we're in control. We're actually going to tighten lending standards, which they did. What does that mean? Making it harder for people to get loans. I think this is going to make it even more harder to get loans. So I think kind of on paper, this is going to look like they're going to make it easier for people, because what did the banks just come out and do? They just lowered mortgage interest rates again if they weren't low enough already. Why? Because I think it's just part of the big macro picture, what's going on. But at face value, people are still going to be able to look at that $300,000, $500,000 or $1 million house or whatever you're looking at and say, wow, this month when I calculated it, the payment went down $54 a month. Honey, take a look. Now we can afford to upgrade. Please, if you're watching my channel, I just don't want you to be one of those family members involved in that right now. Not yet. So it's harder to get loans for things like not only mortgages, but stuff like credit cards. What about like a high interest savings account? Oh wait, those don't exist anymore. How about getting like any sort of positive interest on any sort of savings money? Nope, that doesn't happen anymore. So banks actually got rid of that. It's gonna be harder to get credit cards now. Harder to buy houses. Business loans, not even gonna happen, dude. It's not gonna happen. Yeah, but people are still buying houses like crazy. They might be, but guess what? It's finally slowing down. Macro, it's slowing down. Look at this. The MBA, this is the Mortgage Brokers Association website. These guys are huge. Basically, the guys behind the curtain for all mortgages and the big money dudes for all mortgages, right? When was it? 4 days ago. Mortgage applications decrease in latest MBA weekly survey. The week before that, guess what the headline was? Mortgage applications decrease in latest MBA weekly. 2 weeks before that, we got a little slight increase. One before that, we had another decrease. We're seeing some of these decrease weeks coming in. And we had 2 in a row, all right? I think and I've been saying this, that we're getting on top of that bubble, right? We're at the top of getting to the top of the roller coaster, and we're getting some shakiness up top, where they're trying to float it, but what happens when you get to the top of the roller coaster, folks? Can you tell me? The market composite index, the CMI, heard that? Is a measure of mortgage loan application volume, decreased 4% on a seasonality adjusted basis from 1 week earlier. That's quite a bit. 4% on an adjusted basis, and the index decreased 5% compared to the previous week. The refinance index decreased 5% from the previous week and was 6% higher than the same weeks years ago. Okay, so a year ago, we still didn't have as many buyers as there are now, or people trying to refinance. A lot of people that are still trying to refinance right now are still trying to get out of limbo. So remember that. A lot of people try to refinance their house to pull money out, maybe try to take advantage of these lower rates, but I think if people were going to do that, they probably already would. I think people are kind of in that mode where they're like still kind of in that freak mode, like maybe we can pull out money and buy another house or remodel the house or just get out of the one we had and take the cash. I don't know. The seasonality adjusted purchase index decreased by 3% from 1 week earlier too. See what's happening? Mortgage applications decreased from the second week in a row, with the overall index reaching its lowest since February 2020. That should kind of scare you. Tight housing inventory, which still is there, obstacles to a faster rate of new construction. So just like cars, just like everything, you cannot buy anything right now. You get four-wheelers, Ford F-150s, a new house, a computer chip. Nope. Can't buy nothing. So when you have that suppression, that's also artificially making it so the houses that are on the market are still getting sold, right? Because a lot of the new couples, right, they always want to get like the brand new house, and for good reason, but they're just harder to build. It's harder to even employ people now, just from the new safety standards and stuff. Everything is completely changed in the past year. It just has. Everything is completely different. So when you have that, it also increases it makes it so there's less houses available on the market. That's one of the leading indicators a lot of people use is what's the current amount of competition out there in your said price range. That's a really good way to look at the market, but I think we're getting some artificiality in that too. Just because we can't even build really new houses right now. They're taking forever. The government purchase index declined to its lowest level in over a year and has now decreased year over year for 5 straight weeks. Added CAN, this was in the last report from those mortgage folks, refinance activity dropped for the second straight week, even as the 30-year fixed rate decreased slightly to 3.17%. So you can get a 30-year fixed mortgage for 3.17% right now, even though rates have been below 3.2% over the past month. They are still around 20 to 30 basis points higher than the records low of late 2020. So can you imagine that? Even the standard rates that everyone knows, the 3.7s, the 4 point, the 9.9s, the 13.6s, that's not all that's going on in the background. There's always the background, the back end, right? We're talking about the basis points in the back, huh? Don't ever take things for face value, folks. Look at the whole deal. The FHA share of total applications increased to 9.6% from 9.1% the prior week. I thought that was kind of interesting. All right. You know, FHA does great, you know, for home loans and stuff, but the deal is it's widely known in the mortgage industry that if you got really banging job, money, and credit, you're probably not going to go FHA. Okay? If you get disapproved for the other side of approvals, the big banks we were talking about up above, right? Because they're going to be denying people. What do people do next? They roll it through the FHA now. So, oh, you know what? We try to get you approved on a home loan through Bank of America, Chase, all that. They're wanting some weird terms. Let's try to get you down to the FHA. They'll probably get you a little bit better of approval. I think that's what that's coming from, because why would the other ones decrease, but this one increases? Just still a little bit though. The VA share of total applications decreased to 10.9% from 11.2% the prior week. That should tell you something too. The USDA share of total applications remained unchanged from 0.4% the week prior. So USDA farmer loans, right? Nobody wants to be a farmer anymore. I don't blame them. I want to be a farmer, but I just want to franchise out one of those vertical farms. Right? That's the way I want to start farming. So it doesn't look too bad though, zoomed out, but for sure we're at a downward trend. So this is United States MBA, Mortgage Broker Association, mortgage applications. What does that look like? It's a downtrend. It's totally a downtrend, right? It's slight, but we're definitely in a downtrend. Then this is from, what is it, about a year, right? Because that's July, yeah. So this is a 1 year map. The applications are going down. And we had these freak moments, right? Totally. We had the, like right after March, like blam went up. People got even more scared. It's usually drama, macro drama that's going on. But look at this, right after January, right after tax season, people decided, hey, let's see if we can buy a house now. Right? There's also lots of pump articles of how it's the best time to buy. I don't know, but watch that. Zooming out here at the 11 year, look at this. MBA mortgage application survey for regular. This is the refinancing index. Yeah, this is for refinancing. So people that are currently in mortgages, they want to lower their rate and take advantage of the lower rates so their monthly payment can go down, or pull out money and buy a Harley, but work on the house with it, right? Regardless, what does this look like to you? It looks pretty high, right? This goes all the way back to 2008. It's definitely not as high as 2008 at the beginning, but we've had some big old spikes since then. What does it look like to me? It looks like it needs to come down a little bit. That's what I think. But even more unassuring to me is the mortgage applications for a new purchase index. These are applications to buy a new home. Since 2008, where are we at? We blasted above that. There's more mortgage applications that have happened in the last year than there was in the worst financial housing market crash ever in 2008, 2007, 2009-ish. If we're sitting above a trend line, yes, we're trending this, we're charting this, okay? You can chart this stuff. But look at us now. We're starting to come down. We peaked out again, January of this year. Look where March went. But look at 2008. We basically had like a year and a half, about 2 years of a downtrend. I think we're just starting that. Okay? We might get a little bit of still consolidation for a couple months or something, but what macro is going to make the economy go bangarang all of a sudden right now? I don't know. The Fed is unwinding all their stimulus to the big corporate guys. What else is going to make the economy go super bang, bang, bang? I think we're going to ride it out this summer a little bit, but I don't see the big bang fireworks going on. 20 to 30 year mortgage application refinancing index here. Here's another thing to look at. This thing, 20 to 30 years out. So this is from 1992. You can come look at this chart. Still like in 2002, people were refinancing more. Take that with a grain of salt. But this is, look at this. This is from 1984 all the way back. Mortgage rates. So look at this. People talk about how, parents back in the 80s or whatever had it way easier than you. Did you know that they had to buy a house at like 13% interest rate? A 13% interest rate? I'll show you some math down below that will blow your mind. But now look how low it is. Interest rates are still, we are at all-time lows, dudes. What does that usually mean when you're all-time lows? Stuff's probably going to start going back up the roller coaster and go up. When interest rates do start going up, and remember, just because they just went down a sliver last week, you can see right here that we're actually a little bit of an uptrend, right? This is not technically confirmed, but how much lower are they going to go? I don't know. They could just lower them to 1%. They could pull that rabbit out of the hat, which would be crazy, but I don't know. I don't know. This stuff makes everything artificially cheap, though. See, and that's the problem, and that was also the benefit of buying a house maybe in the 80s. People were buying what they could afford just because of the interest rate alone, right? So here's some math, all right? So let's just say I just use $300,000 as a mortgage amount, right? You know, it's different in every area, whatever, we're using $300,000, okay? So if you were to get an interest rate right now a little bit higher than the average, you'd be at 3.92%, let's just say. At a 30-year mortgage, that puts you at $1,418 a month. Total cost of your mortgage, by the way, would be $510,000. Did you know that? But look at this. If we raise this, let's call it from 4% on up to 7% interest rate, and 7%, if you go look at this chart, 7% looks totally nominal, looks totally mean, like, you know, 7% seems fine when you look at the 30-year mortgage interest rate average chart, VWAP of it, whatever you want to do. 7%, I could see the interest rates going to 7% again. Anyways, your payment, just from raising it 3 points, 3% interest, is going to go from $1,418 a month on up to $1,996 a month. Let's call it, you know, $580 extra a month from 3 little measly little points. That's crazy. So what would happen? What would happen? People are definitely going to stop buying because they won't be able to buy. They can't afford it. When interest rates start going back up, no one's going to be able to afford it. People are already maxed out, budgeted at everything. Don't believe me? I got a billion proofs down below. By the way, that's about a 33% difference from just 3 points. So think of 10% more a month you'll pay per 1% more of your interest rate. Makes you want to have good credit, huh? 10 city home price production. So this is like the top 10 biggest cities in America here. Home price index. What is this showing? The average price of houses, let's just call it, all-time highs. This is all the way back from 1987. Of course, it's going to be more expensive than 1987, but look back in 2006, right? When everyone was like, no, everything's just booming, everything's great, you can get a mortgage, anybody can get a mortgage. People were telling me too that, like, oh, we're never going to have that housing financial crash again because banks aren't loaning as loose as they were. Right, it's not going to be the same catalyst, but there's all sorts of other catalysts we got now. Like last year, you remember what happened last year? Remember that? People had to stay home. Lots of businesses gone. This is a big deal, folks. We're at all-time highs here. We should probably follow this exact trend, that we're probably going to get to the top of that roller coaster. Like I said, you're going to get a little waves. I think we got a couple little months, but watch. Once this thing rolls over, it's going to be nasty, dude. It's going to be totally nasty. Housing inventory, we're talking about this up above. So this is artificially deflated also, right? Because just of building standards right now. It's so hard to build anything right now, unless you're like in Texas maybe. I don't know. If you want to build something in Texas, you just go ahead and build it. Not if you're on any coast though, or Colorado or anything like that, right? Anyways, supply of houses. In 2008, when we had the big housing crash, guess what happened? The monthly supply of houses on the market skyrocketed. Where are we at now? Almost at all-time lows. You see that? Almost at all-time lows, but we're starting to come up. So you have a lot of these charts that were all-time highs, right? Which means we should be going down. The other ones that go the opposite way, like this one, monthly supply of houses. I'm giving you all these charts because I need you to help me and the whole group stay on top of these. right? Because if we can keep watching these things, we're going to be able to predict and make a lot of money on the way down or the way up. M3 money supply, the USA macro money supply, let's call it. Basically, how many dollars are actually floating around the economy? Remember, I was saying how everything is diluted. $100 last year is not $100 this year. Let's call it 71.47 is how much your $100 is worth compared to last year. Don't believe me? Look at this chart. Have we ever seen anything sky so high so fast ever? No. By the way, this is a US recession, are shaded, and the most recent date is undecided. So these like gray bars, these vertical bars you see, those are recessions they're calling them. And this yellow piece on the far right hand side, this is coming from Fred. This is like the USA world macro real financial numbers. There's always gonna be some fibs in here, but this is as legit as gonna get for numbers that we can find from Fred. They're calling what we're in a recession. I thought that was really interesting because I don't think I've heard one news channel, not that I watch the news, but I haven't heard anyone ever talking here ask me about, do you think we're in a recession? Why? Why? I think it's because they're still trying to trap retail. They're still trying to trap the little guys. I've been telling this for a year. That's why I wanted to start this, is to show you guys. Let me slow everything down for y'all and show you how to really make money through all this. Because I know there's these traps in here. But if Fred is admitting that we are in a recession, right? Starting back in March, they're showing you right here with this yellow thing on all these charts, by the way. See that yellow? They're admitting it. How come it's not all over the news yet? Oh yeah, they're gonna wait until we already get like a 50% down, maybe 100% down to match everything else, and then start talking about the recession when it's already too late for people to get out or get in. Don't just think it's the United States though. I talk about this also. You know, people are like, oh, the United States is going down because of the printing. No, because guess what? Everybody's been printing like crazy. Here's the Euro M3. Same thing. Last year up wasn't as aggressive as ours, where it's like straight up to the window, through the wall, right? But don't think the Euro Knights aren't printing like crazy either. And it's nuts over there. Jobs. I got to talk about employment. Change by industry since February 2020. All employees, thousands. Seasonally adjusted May 2021. Leisure and hospitality is still way down. Why is that? Number one, people still aren't really traveling that much. If they do, are they going to places indoors? Can they just not afford to maybe travel as much right now for leisure and hospitality? Oh, then what about all the mom and pop restaurants and even like the big macro places like gyms? I don't know, like Gold's Gym, 24-hour fitness. What about all those places actually went out of business too? So you have the mom and pop little restaurants, but then you have some big corporate stuff like gyms and all that are gone too. These are jobs that have not come back yet. This is huge. Okay, this one was really, really interesting to me because coming into number two of job losses was government jobs. Still half as much as the leisure hospitality, but that is massive. This one also is really crazy to me. Trace, education. So number 3 is education and health services. That just blows my mind. Like, how are healthcare workers unemployed right now? I thought everyone's been saying this whole time that healthcare workers, I don't know, like, what? Education though? Like, I understand, like, teachers are doing stuff via the internet and stuff, but how come there's less educators? Can someone let me know in the comments? I have no idea. Manufacturing jobs, remember what we were talking about? That's number 4. I was saying you can't get anything. You can't get a Ford F-150. Why? Because we can't get the chips from China. So all them Ford workers are out of business. Out of money? Maybe they can't afford to go leisure and hospitality. I don't know. Just look at all this, though. It's pretty nuts. Measuring the job shortfall since February 2020. Actual and counterfactual employment September 2019 to May this year. So employment in the thousands. We had up to 152. 523 is what we're calling this. in actual jobs. And in March, this is what happened, just totally tanked. And this shown here, we've only got 144,894. We were projected to maybe be at like 155, so we're still way down. No matter what, even if you've been employed this whole time, it still affects you when there's that many amount of people that are unemployed. No matter what you do, it will affect you. It's that butterfly effect, man. Here's the one thing no one is talking about, Lou. The nominal wage growth has been far below the target in the recovery. What does this mean? Basically, so we're getting some people going back to work. Fine, people go back to work. I don't care where people work, if they're working at Walmart or Target or the gas station. I'd rather know that person's doing that than sitting at home not, right? But here's the deal. That's actually what's happening. So people that might have been making, I don't know, $50,000 to $100,000 a year lost their booty, all right? They lost their job. Maybe they lost their business. And they're going to take those Walmart and gas station jobs right now. What am I getting at? So jobs is kind of going up, like people are getting some jobs back, but guess what? The wages aren't following it. Okay, so the amount money paid out to employees is down, but jobs keep going up. People aren't making as much money. They're not making as much money an hour. Nobody is. Well, some people are. Unemployment rate from 1948 to 2021. We were banging, right? We were banging. We were doing great. We were all-time lows for unemployment since 1950 last year, which was amazing, right? Great. But guess what? We're still at 5.8%. On paper, again, that doesn't look too crazily bad when you look at the big old macro picture. But again, unemployment rate, it matters, but what really matters is how much money people are pulling in and how much money and things that can afford them. Because remember, we were talking above. Even if you go back to making $50,000 exactly again, you're not making $50,000 anymore. You're only making 42 because those dollars are not worth a full dollar no more. That's what happened when the printing happened. Doesn't that make you want to just like take that $1,200 you might have gotten and just give it back? You know what? Take this back, take it out of the hopper. I want my 50 to be worth 50, not 42 for the rest of my life now, right? That doesn't make any, no, keep your 1,200, man. Keep your 1,200. That's what I think. So this is still kind of like the man behind the mirror. This is still just smoke and mirrors to me. Great, I want people to have a job, but they just not make as much money. But do people want serious jobs like, the ones that pay you more monies? I don't think so either, though. I don't know if this whole thing is like made people just want to stay at home or lazy. Well, I guarantee it has, because people got used to it. Start having bad habits, right? That's just what happens. Share of newly employed workers who said that they were not actively searching for work in the previous month. So this almost goes against the whole thing too, but it's just adding to the pot of the macro picture that people are now just kind of chilling in those crappier jobs they have now. They might say they don't like them, but they're not out there applying for all the jobs either. So maybe they are just happy working by themselves and being an Uber driver and making $8,000 less a year. Or making the same, but then they forget to calculate the money loss they have because of the gas and their car payment on their car and the miles and the tires and oil changes. I don't know. That's interesting too, though. Is this painting a big macro picture for you? I hope. So what do? There's some ways to make money. Well, can we short REIT stocks? Sure. You know what a REIT is? It's like a real estate investment group of real estate stuff. You can get like residential REITs, basically a bunch of residential houses all over the United States or wherever, the world. And it's basically like an ETF of houses. It's all right. You can short these though. You can even ride them up. But look at these rips. This one here is USRT ticker, iCloud Core US REIT ETF. This thing had a rip back in March of 74% down. Can you imagine surfing even a tenth of that down? I'd be pretty happy. Would you? How about this one here? USRT. Same one, but I zoomed out here. Basically, look at that. I mean, back in 2008, when this thing started, it was at $50. Yeah, 50. This thing went all the way to 10 bucks. Can you imagine surfing that? Where are we at? All-time highs. You see in the picture here? You see in the picture? VNQ, here's another one. Vanguard Real Estate ETF. Real famous one. If you're gonna get into any of these, I suggest finding the ones, maybe top 3 with the biggest volume. They're easier to get in and out of. It's just funner to hang around. But look at this. Look at the volume we've even had like on this last one in the past 2 years. It's just been crazy. So people are playing these. But we're sitting at all-time highs. But why? What's really like stimulating the economy right now? Like this very second? Suppose like even if the macro picture was, oh, we're going to start building roads and all that, and we decided we're going to build roads, bridges, we're going to redo all that. Okay, we're going to do that. Does that start tomorrow? No. It's probably going to take 3 years minimum of planning before it actually puts people to work, right? You're going to have the planners, but they're probably just going to build the planners from all the cities, and I don't know. I just don't see a way for them to like switch a button right now and send everyone off their couch to making 100 grand a year. I just don't see it. How about this though? Inverse REIT ETF. So we can go inverse. You can just buy these instead of trying to short these ones. You can just buy the inverse ones. Here's one: ProShares Real Estate REC. What a great ticker. REK. This one's down 34% because it's the inverse. So when the real estate market goes down, this will go up. But right now the real estate market's been going up, so it's going down, right? That's a 1X. We got a 2X one here, SRS. You can get that one. We got a 3Xer called DRV, man. This one's down 76.9%. In March, it's about a 70% ripper. I'm finding most of these ripped about 70%. What does this look like? It's just that boring downward trend. But if you can catch this, I mean, and even if you were to really watch these throughout the day, even maybe set something up for volume alert or something like that, I don't know, something like that. It looks like you probably have a good week to try to catch this thing before it rips to high heaven, right? Just be careful on these inverses if you get into these, because these do, let's call it degrade. Basically, it's kind of like an option where it loses value. It'll get crushed, basically. The easiest way to say it, just don't think you can sit in like a 3X leveraged ETF and your money will always be there. It's not going to happen like that. So play it, right? The 1X is not as risky, 3X definitely riskier, right? About shorting mortgage or banking stocks. Home builders. Here's a home builder stock. This one's called NAIL. Directional Daily Home Builders and Suppliers. A Bull 3X is a 3X home builders. What did this do back in March last year? It went from $100 a share down to $10 a share. But look at this macro chart, dude. It's like every 2 years, this thing has like an 80% rip up or down. Where are we sitting? Well, we were at all-time highs 2 weeks ago. About a week ago, we're at all-time highs. By the end of this week, though, we've gone down a little bit. Maybe like 20%, 25%. Watch this one though, because remember, just because people claim to want new houses, it's going to be harder and harder for them to get approved because of tightening standards, right? Because of that push we're talking at the beginning. Put all this together, okay? We want to build it, but can we even get the supplies? I don't know. Are we out of steel? I don't know. You can even buy puts on something like that, You can buy puts on something like that. Open Door, I don't know. I guess you could. But I think Open Door, remember that one. Here's the thing with a lot of these mortgage stocks, they're not doing good at all. Like Rocket Mortgage, Open Door, they have their rips, but people aren't touching them. Why? Is it because the stock bros just really pumped those up? Or is it because people know that the housing market ain't gonna last as high, man? all the macro bros I know that are, big real estate guys, they've been out. Been out for about a year. Yeah. If you're bullish on, if you're bullish on stuff going up though, here's a couple links where you can actually like buy into REITs without buying stocks. You actually get a little bit better of a coverage with them, a little bit better of an ends, but I don't like playing any of these. But you go to like fundrise.com or equitymultiple.com, they let you invest in private deals and private REITs, way less liquid, but some interesting strategies for it. You can just realize stuff like that exists. I maybe put that in your back pocket for when stuff is really cheap. Right now, stuff's not. Okay. Or what if I don't touch any real estate and just buy other stuff? Then when stuff is like 55% off, then buy some real estate. You can do that too. If you don't like, I'm not like a shorter guy. I'd rather buy calls, stuff going up. I don't know. It's easy for me to surf stuff, but I want to keep my eyes on this. I really think we're getting topped out. I just gave you 10,000 reasons. What do you think? Am I losing my mind? Can you tell me what thing can totally stimulate the economy in the next couple months? I don't know. Other than let's call it pixie dust, like fake stuff, like whatever. There can be tons of articles that start booming and hitting everything, saying the economy is great. It's gonna be great. It's gonna be great. We're gonna have more jobs, all that. So people can get excited. We get that and call it fairy dust on stuff. But just be aware. The reality is, it still ain't doing that great. At least that's what the charts tell me.
Whoa, check out this new coin I made. If you want to buy one just like this, just head to the website and click Buy Silver. Please friend us on Twitter and StockTwits.